Here's a question most investors never ask. Is this stock actually worth what I'm paying for it? You can find a great company, strong revenue growth, expanding margins, solid management, and still lose money if you bought it at the wrong price. That's the difference between a good company and a good investment. Today I'm going to show you how to use AI to estimate what a stock is actually worth. We're going to run a simple valuation, interpret what it means, and use it to make a better decision. This is one of the most powerful skills you can build as an investor, and most people never bother. Let's get into it. Welcome back to the AI Portfolio. I'm your host, a CFA charter holder with years of professional market experience. This channel gives everyday investors the same tools and thinking that used to be reserved for Wall Street, free every week. Nothing here is financial advice. This is a research skill. Let's build it. All right. We're going to use a valuation method called a discounted cash flow model, or DCF. Before you close the tab, I promise this is simpler than it sounds. Here's the basic idea. Every business generates cash. A DCF asks, if I add up all the cash this company will generate over the next 10 years, and adjust for the fact that $1 today is worth more than $1 in the future. What is the company worth today? That number is called the intrinsic value. If the current stock price is below intrinsic value, the stock might be undervalued. If the price is above intrinsic value, you might be overpaying. We're going to let AI build this model for us. Open ChatGPT or Claude. Paste this prompt. Write it down or pause the video. Please run a simple discounted cash flow valuation for company name. Use the following assumptions. 1. Use the most recent annual free cash flow as the starting point. 2. Assume a revenue growth rate of X% for the next 5 years, then Y% for the following 5 years. 3. Use a discount rate of 10%. 4. Assume a terminal growth rate of 3%. 5. Use the current share count to calculate intrinsic value per share. Show me your assumptions, the full calculation, and the resulting intrinsic value per share. For growth rates, a reasonable starting point is to use the company's actual historical growth rate for the first 5 years, then cut it in half for years 6 through 10. AI can look this up for you. Just ask. Let's run through a real example. I'll use Microsoft. The prompt would look like this. Please run a simple discounted cash flow valuation for Microsoft. Use the most recent annual free cash flow as the starting point. Assume revenue growth of 15% for years 1 through 5 and 8% for years 6 through 10. Use a discount rate of 10% and a terminal growth rate of 3%. Show me the full calculation and intrinsic value per share. What comes back is a complete 10-year model with an intrinsic value per share. You can then compare that number directly to today's stock price. Now, and this is important, DCF models are sensitive to assumptions. If you change the growth rate by just a few percentage points, the intrinsic value can shift dramatically. That's not a flaw. That's the nature of forecasting. What the model gives you is a framework for thinking, not a precise answer. So here's how I recommend using it. After you get the first result, run this follow-up prompt. Now show me a sensitivity table. What is the intrinsic value per share if growth in years 1 through 5 is 10%, 13%, 15%, 17%, or 20%. Keep all other assumptions the same. What you get back is a range of intrinsic values under different scenarios. The current stock price should fall somewhere in that range. If the price only makes sense under the most optimistic assumptions, that's a warning sign. If the price looks cheap even under conservative assumptions, that's interesting. Let me walk you through what each part of the model actually means, because understanding the mechanics makes you a better analyst. Free cash flow is the cash the business generates after paying for everything it needs to keep running. It's the real profit number, harder to manipulate than earnings, and more directly tied to the value of the business. The growth rate is your estimate of how fast that free cash flow will grow each year. This is the most important and most uncertain input. Being honest and conservative here matters more than getting a precise number. The discount rate we use 10% reflects the return you require as an investor. 10% is a common benchmark because it roughly matches long-term stock market returns. You're essentially asking, would I rather own the stock or just own the market? The terminal growth rate, we use 3%, is what you assume the business grows at forever after year 10. 3% is roughly in line with long-term GDP growth. It's a conservative assumption, and intrinsic value per share is simply the total present value of all those future cash flows divided by the number of shares outstanding. That's the number you compare to today's price. Here's the full workflow so you can use it on any stock. Step 1. Identify the company and look up its most recent annual free cash flow and historical growth rate. You can ask AI to pull this for you. Step 2. Paste the DCF prompt with your growth assumptions. Get the base case intrinsic value. Step 3. Run the sensitivity table. See how intrinsic value changes across different growth scenarios. Step 4. Compare intrinsic value to the current stock price. Is it cheap, fair, or expensive? Step 5. Combine this with what you already know from episodes 4, 5, and 6. Is this company on your watch list? Did it beat earnings? Did it beat its competitor in the head-to-head comparison? Now you know if the price is right too. That's the full research stack. Screener, earnings, comparison, valuation. 4 tools, all free, all powered by AI. Your homework this week, take the company you analyzed in episode 5 or 6 and run it through this DCF workflow. Drop your intrinsic value estimate and the current stock price in the comments. I want to see what you find. Next week, I'm going to show you how to put all of this together into a one-page investment memo, the same format professional analysts use to summarize a stock idea before making a decision. Subscribe so you don't miss that, and I'll see you in the next one.